Ladies and gentlemen, good day and welcome to the Sterling Wilson Renewable Energy Limited Q2 FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Thomas Mathew, Head Investor Relations, for his opening remark. Thank you, and over to you, sir.
Okay, good morning, everyone. Welcome to our Q2 FY25 earnings call. Along with me, I have Mr. Amit Jain, our Global CEO, and SGA, our Investor Relations Advisor. We will start the call with the key operational highlights for the quarter and industry outlook by Mr. Amit, followed by the financial highlights, post which we will open the floor for Q&A. Thank you, and over to you, Amit.
Thanks, Sandeep, and a warm welcome to all the participants on this call. I would like to begin with a quick update on our business operations and outlook. We have continued to build on the strong ordering momentum of Q1 by announcing an additional rupees 2,044 crore worth of new orders in Q2. Our total new order inflow this fiscal have touched rupees 4,214 crore thus far, and are happy to report that we remain on track to meet our full year order inflow guidance of rupees 8,000 crore. Our unexecuted order value now stands at over rupees 10,500 crore, and it is the highest in the company's history. While Q1 ordering activity saw a mix of international and domestic orders, all our orders in Q2 were from domestic market. One of our key order wins this quarter was the LOI for 2 into 250 megawatt AC standalone BESS plant at Rajasthan by JSW. This project till date is India's largest battery energy storage project and one of the very few projects of gigawatt-hour scale in single location globally, which shall be executed by 2025. This project win is a significant development, as over the last 12 to 18 months there have been multiple tenders and bids of projects for either standalone storage or hybrid, that is renewable plus storage in India, making it a very important step for us as a company. This win depicts our in-house capabilities and knowledge for energy storage system engineering and execution and places us with a large advantage in the fast-growing solar and storage market. Additionally, the company has also been awarded a LOI for 20 megawatt floating solar project at Vijayanagar from JSW, which marks the third such floating solar project the company is currently executing in the country. We achieved a key breakthrough with Brookfield, one of the leading global renewable private IPPs in the country, through the balance of system order for a 633 megawatt DC project in Rajasthan, India. Scope of work includes engineering, design, testing and commissioning the PV plant along with supply and works for a 220 kV switchyard. Repeat orders are a testimony of a good EPC contractor, and we are happy to have bagged repeat orders from NG and Ampere for their PV projects in Gujarat and Maharashtra respectively. The latest order which we received yesterday was a turnkey project by NTPC for a 200 megawatt AC or 300 megawatt DC project in Rajasthan. With this order, we continue to strengthen our relationship with one of the biggest renewable developers in the country. In terms of execution, we anticipate a very strong pickup in execution in the second half, as we had indicated in the previous conference call. We have all building blocks in place to meet our revenue guidance of 8,000 crore for the year. We have significantly strengthened our engineering, execution and support team in India to achieve significant ramp up in execution in H2. The recent 500 crore loan sanctioned by IREDA and the credit rating upgrade received last night, moving us to investment grade, will go a long way in helping us achieve our revenue guidance. On unexecuted order book currently stand at 10,559 crore, with approximately 78% constituting domestic orders, while our international UAV pertains to 2 projects in Europe and 2 projects in South Africa. We are continuing to see a very strong bid pipeline in place for India, with over 23 gigawatts of projects likely to be awarded in next 6 to 12 months. Apart from the typically strong PSU pipeline, we are also seeing a strong pipeline of private IPP projects coming to fore. In H1, 11 out of 12 projects that we have won have come from private sector. Our existing private customers have exciting growth plans, and we are confident of growing the order book with them in H2. Simultaneously, a majority of the PSU bids will get finalized in Q3 and Q4, which will lead to a much larger addressable market for us in H2 as compared to H1. We continue to judiciously evaluate projects in India and overseas, and are mindful of having to remain patient in order to target profitable orders. Moving to Nigeria projects, we are still awaiting final order signing, which we are expecting to happen soon. Also, as I have mentioned in earlier calls, post-order signing, we expect project to take 6 months to achieve financial closure. We would like to reiterate that lumpiness in order inflow is to be expected with EPC company like ours, and timelines for achieving project closure could vary depending on a host of factors, including finalization of contractual terms, financial closure, etc. Our O&M portfolio outlook remains strong, and portfolio stands at 7.8 gigawatt as of September 2024. The benefit of a larger portfolio is expected to bear fruit in the coming quarters, as our EPC pipeline will continue to feed a large portfolio of O&M projects over the next 12 to 18 months. Now, moving to industry outlook, India has been our single largest focus market for the past 3 years, and we have been constantly endeavoring to grab a larger pie of the market. We are continuously recalibrating our strategy as market evolves. From only pure play BOS, we have also taken up few turnkey projects strategically and looking to tap into new opportunities like BESS. With a strong balance sheet, we remain well positioned to tap into strong industry growth in both domestic and international markets. With this, I will ask Sandeep to take you through consolidated financial highlights. Thank you very much.
Thank you, Amit. We are very happy to report a third consecutive quarter of positive EBITDA, PBT and PAT at a consol level in this quarter. Our operating revenue for Q2 FY25 was 1,131 crore. Revenue grew 36% year-on-year and 13% sequentially. Our top line for the quarter was largely driven by our domestic EPC execution. On the margins front, our consol reported gross margin was approximately 10% in this quarter. However, it is important to note that while our domestic margins was lower at 9%, approximately 10% of this domestic revenue that was booked in this quarter was cost equal to revenue in some projects which were yet to achieve the POCM threshold. If we adjust for the same, the blended gross margin for the domestic turns out to roughly about 10.5%. As stated in the previous conference calls, we believe that our domestic gross margins will hover in the 10% range in this fiscal year. Our O&M gross margin at 28% was higher than average due to lower expenditure that was incurred in Q2. However, we anticipate these margins to normalize due to post-monsoon maintenance that is likely in the second half of this year. Recurring O&M margins are trending towards more steady-state margins of approximately 25% that we have guided to previously. On the overheads front, we do believe bulk of the optimizations we had planned have been incorporated and current levels are likely to sustain. Reported Q2 EBITDA was 51 crore at a nearly 5% EBITDA margin in this quarter. Our PAT of 9 crore, while significantly higher both on a year-on-year and sequential basis, continues to remain impacted by a non-cash deferred tax asset charge in this quarter, as was in the case both in Q4 FY24 and Q1 FY25 due to the standalone profitability. We are very excited to report a key development that has happened overnight, which is our upgrade in the credit rating. Our long-term ratings have been upgraded one notch to investment grade or BBB minus from BB plus by Equity Ratings yesterday. This is a positive development which is expected to give a favorable push to our execution plans in the forthcoming quarters, as Amit had alluded to earlier. Our order book continues to grow rapidly, and we have achieved one of the highest unexecuted order value in the company history at rupees 10,549 crore, and this provides a higher revenue run rate visibility for forthcoming quarters. With anticipated easing of the liquidity challenges, we still hope to be able to meet our annual revenue guidance, which, as we had guided in the last quarter conference call, implies a strong execution pace pickup in the second half of this fiscal year. We plan to achieve this execution scale-up through the new 500 crore loan facility that we had availed from IREDA, fresh sanctions and restoration of non-fund-based limits with the credit rating upgrade that happened over last night, and also through negotiation for open credit with large key vendors. Now, coming to the balance sheet, our gross borrowings have increased this quarter due to the new 500 crore loan facility that we had availed from IREDA. Our non-fund-based limits were constrained in Q2 as we had to pay some of our vendors in shorter cycles to ease up limits. With our long-term ratings back to investment grade, we are confident of obtaining fresh non-fund limits to scale up execution as I had earlier alluded to. Total net debt stands at roughly 326 crore as of September 24. On the indemnity proceeds, there are approximately 109 crore which is being billed, and it is largely expected to take care of debt repayments due in the second half of this fiscal year. The company continues to remain cash out on approximately 800 crore of indemnity-backed legacy projects, which we believe will crystallize fully over the course of the next 24 to 36 months. With this, we can now open the floor to question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet from HSBC. Please go ahead.
Yeah, thank you so much and congratulations on good order wins. Can you talk a bit about what really do you mean by the LOIs that you won on the BES project? Are these firm orders and what should be the quantum and scope of these?
Yeah, all the orders announced by us are firm orders. Either we have signed the contracts or firm LOA has been received. So all the orders are in place, and the order which you are referring to is 200 megawatt AC, 1000 megawatt hour or 1 gigawatt hour plant in Rajasthan by JSW.
Right.
It's a balance of system plant, and batteries to be supplied by the client for this project.
Okay. But you also mentioned that there is some turnkey project that you are now beginning to take as a part of your change in strategy.
Yeah, turnkey projects, because as you have seen in some past quarters also, that some of the projects we have taken which include the supply of modules. So that's what we mean by the turnkey project. Some of the projects which are being floated by public sector units are including modules. And yesterday, with the one LOA we have received, it is also including the supply of modules. And that's what we mean by that we are now accepting turnkey projects also as a change in strategy. So we are selectively taking the projects both on supply, including module supply as well.
Right. And can you also talk a bit about what is the competitive intensity in this space?
So as market is growing significantly, market is exploding completely. And as market is growing, more new players are also entering into the market. So competitive intensity is going up, but we have been very careful in picking up the orders. So we have alluded in our speech that H2 alone, the domestic market size is 23 gigawatt. So market is growing, number of players is going, competitive intensity is going up, but there is enough space in the market so that we can take the orders within our defined risk metrics and our expected margins level.
Understood. And can you also define the size for the first half of the year? What was the market size? For example, 23 is what you claim for second half. What was the first half and what was your market share there?
Market size was roughly close to our addressable market, where we chose to not bid for some of the projects. Wherever we bid, our success rate was approximately 46%, and the complete market share of the addressable market was 27%, the orders which we have won. You can say roughly 16 to 7,000 crore was the addressable market size.
In the first half alone?
Yeah.
Yeah. Okay, that's it. Thank you so much and all the best.
Thank you. The next question is from the line of Rohit from Aditya Birla Sun Life. Please go ahead.
Thank you. Thank you for this opportunity. So my first question is more to do with the non-fund based limits. Earlier, I was under the impression that your non-fund based limits is quite low. Probably that will restrict your execution in the second half. But now, as things are improving, as you said in your opening remarks, and you seem to be confident about achieving the guidance or retaining the guidance, earlier guidance, I would like to understand what exactly has changed in those aspects, especially on the non-fund based limits. What are we, at what position we are, and what does this rating upgrade imply? If you could throw more color on it.
Sure. So Rohit, the one thing that you have to understand is we've already been doing with the current limits about 1,000 crore run rate on top line, right? Over and above this, we have now got a fund-based facility for 500 crore from IREDA, which came in pretty much at the end of September. So that also gives us now further ammunition. Now, obviously, with the credit rating upgrade, we believe that some of the limits that were earlier frozen, and also for fresh limits, now that we move to investment grade, we will see a significant interest from banks, and we should be able to execute at the run rate that is required to meet the execution guidance that we've given for the rest of the year. So that will be a gradual pickup, but we anticipate that things will begin to move very quickly. And the loan that we had also taken in place was a backup plan in case the rating upgrade which happened overnight got delayed, like it has had in the past. So that is what has effectively changed, and we will also be relying on open credit to facilitate faster execution, and those are essentially the three things that will work for us going forward to be able to execute at a much higher pace than what we are doing currently.
So I really appreciate this remarks, but just to help me understand in the calculation, as in if I use 10 billion non-fund based limits plus this 5 billion from IREDA, that is I get a limits of total funds, this exposure is 15 billion, which I churn it 4 times a year. 60 billion is the cost and 66 billion is the revenue. Is that the working? And maybe with this credit rating upgrade and maybe some limits that gets unfrozen, eventually it could move to that run rate of 80 billion. That's the way it works like?
Over and above this, there will also be open credit, Rohit, like I alluded to. So that will also come in to the picture. And this 1,000 crore that you're talking about, those numbers also will move up with the credit rating upgrade that has happened.
Got it.
So on top of that, I would like to add that some of our key suppliers, key components, including the module supplier, tracker supplier, and some of the most reputed cable suppliers in the countries, are looking at our improving balance sheet and the order book, have agreed to offer us very good, attractive open credit terms, which will help us significantly ramping up the revenues in next 2 quarters.
Got it, sir. Thank you. My second question is more to do with this credit rating upgrade only, because we earlier also have had this credit rating upgrade. But the moment this consortium of bankers come onto the table, discuss and get things approved for you, what could be the timeline that is from this upgrade to that limits being unfrozen? What is that time frame?
Rohit, we have already been talking to banks. The process has been an ongoing one, right? but anywhere in the next 30 to 45 days, I think we should be having most of the incremental facilities that we're talking about in place. And like I mentioned, this is not it happened yesterday or last night, and then therefore we are now going to start initiating. They've already been continuous dialogue with the banks. They are aware of, the developments that are happening, the requirements that we need in terms of non-fund based limits, etc. And, we found that most of our bankers have been extremely supportive of, the alcohol case as well. So, we should start seeing things beginning to pick up very soon on that front.
Got it. And my final question will be, this Nigeria order is a big order. Would it entail any of your parting of this non-fund based limits to that particular order? Because it's a big order and they may also release some guarantees, advances to you, and you may possibly require to furnish some guarantees.
No, not necessarily. They will be separate facilities because this will be done by a US subsidiary, as you may be aware.
Okay, got it. Thanks a lot.
Thank you. The next question is from the line of Aegis Lakhani from Unify Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So Amit and Sandeep, I wanted to understand if you could lay out the execution pipeline to whatever extent is possible, because effectively till now we were constrained with limits which have now opened up. Order book was always good and enhancing, which has further got better. So could you please outline and nuance the exact execution details that you are going to entail over the next 6 months?
So as we have guided that revenues for this year are going to be 8,000 crores. So we have already achieved more than 2,000 crore in first 2 quarters, and the revenue guidance for the H2 remains 6,000 crores. So we'll execute the projects to achieve the guided revenue. Now all the credit facilities and the rating upgrade has taken place, which will help us to achieve the desired revenue rate, which is required to meet the revenue guidance. Already the execution teams and engineering teams are in place completely to handle this volume of the projects. So the 6,000 crores is the quantum which we will be achieving in next 2 quarters.
Okay, Amit, could you nuance that with, where are clients in that journey? Where are we as a procurement order?
Roughly 4 gigawatts. So most of the clients as of now are either in Gujarat or Rajasthan, and there are 4 international projects. Two of them are going in Spain and 2 of them in South Africa. So Spain project is also all the international projects are also moved ahead, except the one which we got recently, for which we got LNTP a couple of weeks back. So all the 3 projects are taking off. The orders and engineering has been finalized, and the goods have been, we have started shipping equipment to the sites. In India, the 4 gigawatt of portfolio we are executing in Khavda. So all the projects are in advanced stage, and we are expecting, or we are targeting to commission all the projects in Khavda before the next monsoon. The other projects for most of the private IPP players are in Rajasthan, which quite a bit of portfolio is targeted to be commissioned before March. So that's how we plan to execute our entire portfolio and achieve the turnover of or revenue of 8,000 crore before the financial year. And we have over 2,000 crores of open credit from the large vendors, in addition to the credit facility and the rating upgrade which has happened. So all this put together will help us in achieving the revenue guidance.
That's very helpful. Thanks for that answer, Amit. Amit, could you also just nuance the fact that out of the 6,000 crores of orders that you are likely to do, if it is possible, could you nuance that how much is likely to come from the private sector, because that has a certainty of a deadline? Because let's say for any reason Khavda and PSU could be delayed, or is there scope for delay because, say evacuation sites are not ready or any such event because of which the revenue could spill over even further? So I'm trying to really understand that how tight is
So I will give you exact clarification on that. Either be private or as far as the PSU projects are concerned, even evacuation doesn't impact revenue guidance. So all the projects in Khavda are in advanced stage. The modules were to be supplied by NTPC. NTPC is now finalized all the orders and supplying modules to us. So on Khavda, either by NTPC or GIPCL, I don't see any concern there as far as the revenue part is concerned. So we'll be supplying our total part and completing the construction of the project where more than 95-97% of the revenue lies. So on all the PSU projects, we'll be achieving revenue and I don't see any delay anywhere. And similarly on the private part also, we are not forcing any delay. So as far as the delay either on account of evacuation or supply of materials, there is no at all any concern on that front and we are very confident of achieving those revenues. So we have carefully gone through all the project status, what can be constrained, and after considering all those factors only, we have given this guidance.
Okay, I take that. Sandeep, my next question is, could you clarify the adjustment that you made, where you stated that on an adjusted basis, the gross margins would be 10.5%. Could you explain that again, please?
Sure. So, Aegis, if you had noticed our total revenue for this particular quarter in the domestic segment, right, EPC segment was 900 odd crores. To which roughly about 90 crores of revenue was cost equal to revenue because it had not reached, because those projects we are yet to recognize margin on those because they have not reached the threshold. So till they reach the revenue recognition threshold, we do it on a cost equals revenue basis. So in forthcoming quarters, you will see the margins on those projects come in and effectively your overall gross margins on the domestic segment normalize.
Got it. Thanks for that clarification. Lastly, could you just tell me if it is possible to disclose that how much of the non-fund based limits have actually got released and how many were locked on account of, the credit rating upgrade which just came through?
No. So the credit rating upgrade has just happened last night, Aegis. So give us some time. I think we'll be able to probably in the next quarter give you a better clarity on what are the incremental limits that we have got in place. Like we had mentioned earlier, we have total limits of roughly about 4,000 crore that we have. We have total limits of about 6,000 crore of roughly 4,000 which was utilized. And we are working towards essentially freeing up further limits and also working on new limits. Almost, in fact, we're looking to double our existing LC limits that are available currently at this point.
Noted. Sandeep, the credit rating, disclosure which you put out said that the total, quantum was 7,350 crores and you mentioned 6,000 crores. So could you explain me the difference?
So this includes unallocated limits for the new banks.
Okay. So what you're saying is you were operating with about 4,000 crores of limits. 6,000 is just, 2,000 incrementally is just a release once the upgrade happened and plus newer limits that you were trying to get.
Correct.
Okay. And how quickly do you foresee, the limit enhancements by banks? Is it, again going to probably take a month and a half?
So see, some of the proposals have already received in principle approval. Like I had indicated, we should in the next month or so be able to start utilizing some of them. We already have some additional limits in place for our international projects as well. So they are already in play. As we go along this particular quarter, I think, by the end of this quarter, we will be able to give you a much better clarity on where we stand on the fresh limits that we have availed.
Perfect. Sandeep, and just lastly, could you share that, given that there was a constraint on limits, was that limiting our ability to participate for incremental order book?
No, that was never a constraint for us because we were able to provide all the bank guarantees which are required for public sector units. So that was never a constraint with us. So we were participated in the bids which we chose fits our target pipeline.
Got it. All the best